Prop firms are for suckers. Yeah, I'm not holding back this time. At first I was like, maybe I should soften the blow because most of the futures trading community are using prop firms at this point. But then I remembered I'm a trader and there's nothing I love more than taking a trade against the crowd. That's where the biggest gains come from. So yeah, funded trader programs or prop firms are a predatory business, and you are a sucker if you're paying evaluation fees month after month. Ladies, if you're here because your husband wants to try this new prop firm idea and you're not sure if it's a good idea, just tell him no. It's not worth your energy. There, I saved you months of grief, and all I'm asking for is a little like. I really appreciate those likes, by the way. Here's the thing. When I started this YouTube channel, Top Step Trader and Earn to Trade were the only funded trader programs around. Since that time, the number of programs has proliferated. There's even websites to help you compare the dozens of options. Now, I started out as a trader doing evaluations too. I've even done a sponsored video and had a referral link at one point. As time went on though, I started to realize the reality of the industry, and now I won't even touch it. I do not have funded trader referral links, and I don't have much respect for creators out there that do, especially not these guys that have a link for literally every prop firm out there. Good grief, guys, have some respect for yourself. There are better ways to make money than prostituting yourself to every prop firm out there. Look, affiliate links are okay, but the funded trader product they're promoting is not good for traders. By and large, funded trader programs are preventing retail traders from finding more realistic and sustainable strategies. So today I want to prove that to you and show you all of the problems with funded trader programs. We're going to do a little bit of programming so that you can see the statistics, and that will help you understand why the programs are designed the way that they are and why they are so predatory. So I want to start out by showing you what we call a Monte Carlo simulation. So what we do is we basically set up what the rules of the game are and then play that game tens of thousands of times with random values to see how it turns out. So the classic application of this method is using a Monte Carlo simulation to calculate the value of pi. So imagine we have a square here with a circle in the center of it, and we start randomly throwing darts at this board. For each throw, we can measure how far it lands from the center. And if that measurement is less than the radius of the circle, then we consider it a hit within the circle. After thousands or millions of throws, we can look at the percentage of throws that landed inside of the circle and basically calculate pi. And the more iterations that we do, the more accurate our estimate of pi will be. So I'm going to do something similar with a trader evaluation, and this is actually what the prop firms do themselves to figure out what rules they should set and how much money they're going to make. So we're going to simulate a trader taking random trades and seeing if they can pass the evaluation. So in our simulation, we're going to assume that the trader's strategy has no edge and their long-term expectancy is 0. Their long-term expectancy might be 0, but that doesn't mean that they can't pass a combine in the short term. So to make their expectancy 0, the percentage chance that their trade will be profitable depends on the ratio between their stop and their target. We're also going to make sure that they have pretty decent risk management. So they're only going to take one trade a day to make sure that they will never break the daily loss limit. And the only thing that will cause them to fail the combine is if they hit the drawdown limit. Now, of course, I will put the code up on GitHub so that you can try running this simulation yourself. So it'll have the code, what you need to install, everything that you need to run the simulation yourself. That way you can like change the rules, see how it affects the number of traders that pass. And this picture is the result that we get. It is tracing out the profits and losses of every trader in our simulation. Now, there's a couple of interesting things that we learned from this simulation. First of all, the big number that we get is that about 1/3 of traders in our simulation pass. That's interesting because the stats that we get from trader evaluation programs themselves suggest that only 10% of traders pass. So I guess people are doing worse than random. It also suggests that if your strategy is random, it should only take 3 or so tries to pass the evaluation. So like I said, if you're paying for trader evaluations month after month, you know where I'm going. Now, there's another thing this image is showing us that might not be as obvious. It's not evenly distributed. There's sort of a skew to it. So what this is showing us is that traders who fail do so more quickly compared to the ones that pass. So if a customer fails, it takes less than a month, and they might even decide to buy another evaluation or a reset. When they do pass, it's more likely to take more than a month, and so they end up having to pay the evaluation fee multiple times. I tried a bunch of different things, like does it matter whether the trades are bigger, but all that really changes is how long it takes you to pass the evaluation, or does it matter what kind of risk reward you're using, and that apparently doesn't change things. The only thing that really affects the percentage is the ratio between the drawdown and the profit goal. Okay, so what? If people want to take the chances, why not? Well, if you want to do it, knowing this information, then go for it. Just realize that it's probably hampering your progress as a trader. Let me show you what I mean. So here are some of my own stats for trades taken in the past 2 years. This is not to toot my own horn, okay? These trades don't really actually count. They are sim trades, and I'm taking on a lot of risk to get these results. But there are some things in these stats that I am quite proud of. For instance, the win rate is almost 60%, and this is despite the average favorable excursion being twice my average adverse excursion. So my stats suggest that there's some pretty considerable edge in what we're doing. If we could get 5 years of live trading data like this, we would have a pretty good case to start a hedge fund. But here's the thing, this performance would not pass the funded trader evaluations. I have losses in there that are larger than the daily limit. The drawdown would break their rules. It would take several months to pass, and I did it with the 10-year treasuries, the ZN, which apparently the combines don't allow anymore. When retail traders develop their strategies, they typically look for strategies that will pass the funded trader programs for them. And that ironically prevents them from finding strategies that are actually long-term sustainable. That's because the purpose of the evaluation rules is to make enough traders fail for the firm to make money from the evaluation fees. So they give you rules that you are likely to fail under typical market conditions. Like they give you a daily loss limit that is around 1/3 of the S&P's average true range. Okay, so then I can just purchase a bigger combine, and that way I get a bigger daily loss limit, right? And that's why the average target to drawdown ratio on the larger combines aren't as good to make up for the people that don't fail from the daily loss limit. Can you see it now? This is why I hate calling them prop firms or even funded trader programs. A prop firm makes money from trading their own account, but these prop firms are mostly making money from people paying for evaluations. They're really more like trader carnival games. They make money primarily from you failing at a game that is basically stacked against you. And this is why I say that overall funded trader programs hold traders back. Look, I fell for the same trap, and it wasn't until I stopped trying to hit the crazy evaluation targets that I was able to develop more sustainable strategies and find longer term success. The combine basically forces you into trading too big. Otherwise, it just takes too long to pass the evaluation, and most people want to do it in 1 to 2 months. So in order to stay within the evaluation parameters, you have to bring your stop in, and your stop basically ends up being a smaller percentage of the day's range. What I've done in the results that I showed you is I sized it down so much that my stop can be a significant portion of the day's range, and then I set much more reasonable profit expectations. Instead of looking to practically double your margin within a month or two like the combines are asking you to do, I'm looking to maybe make 10 to 15% per year. And that's really respectable. That's more than what most professional funds do. But the thing that really grinds my gears is that in most of these cases, you never actually get to live trade. Passing the evaluation just gets you to what they call sim live. So you can get payouts but it's not a live account. You aren't submitting any live orders to the exchange. So you're not trading. Instead, your payouts come directly from the prop firm's profits, meaning that they make less money if you actually get a payout. That's a really huge conflict of interest. And it's really just delusional that so many people think that they're gonna come out on top in that situation. For some reason, everyone thinks they're the one that's going to get away with it, that they're the one that's actually going to make money from the scheme rather than being another sucker. Look, when I started trading, the whole prop firm idea really made sense. The cost of entry to day trading futures was just so high for the vast majority of people. But then the CME introduced micro contracts that were 1/10 the size. And then they released micro treasury yield futures. That's an instrument where the volatility and tick size is so small that you're literally only risking $10 to $20 at a time. Yeah, it's not much, but at least you're trading, which is more than I can say for most of the people doing these funded trader programs. So think on that one. I'm sure we'll have many more videos on this subject. I had a ton of research. Halfway through writing this, a prop firm went under and basically did a rug pull. Maybe we can talk about that, but we'll see what you guys say in the comments. I will see you during the next live stream. And in the meantime, guys, stay excellent, team.